Hello everyone. In this video today, we're going to be going through the topic of recording goodwill. So basically, goodwill is the excess of the price paid by an acquiring firm over the fair value of the target firm's net identifiable assets. Okay, so it's basically the amount paid over and above the fair value of the net identifiable assets of the target firm. Okay, the acquiring firm is the firm that purchases another firm, whereas the target firm is the firm that is purchased by an acquiring firm. Okay, so generally you have basically an acquiring firm and they're going to purchase a target firm. Okay, and basically what happens is that the acquiring firm is going to pay a certain amount to acquire all the assets of the target firm, and when they pay more than the fair value of the target firm's net identifiable assets, we have something called goodwill. Okay, the net identifiable assets means all the assets of the target firm that are identified minus all the liabilities of the target firm that are identified. Identifiable assets would include all assets on the balance sheet, but also could include other assets that are discovered during the due diligence phase of a business combination. So a lot of times, due diligence is, where you're kind of determining, what's going on in the business combination, what are all the assets, what are all the liabilities, things of that nature, okay? And you might identify some other assets that were not actually on the balance sheet when you bought the company, okay? Then you have identifiable liabilities, which includes all liabilities on the balance sheet, but also could include liabilities, right? Could also include other liabilities that were discovered during the due diligence phase of the business combination, okay? So basically, again, it's all the assets and liabilities that we can identify. That's the net identifiable assets. The way you get it is you just say, okay, my assets that I can identify minus the liabilities I can identify. Okay, well, that would be my net identifiable assets. Net identifiable assets. Okay. Then, so if XYZ company acquires ABC company for $1 million and the net identifiable assets of ABC are $600,000, then goodwill is $400,000. So again, it's just the excess of the purchase price paid over the net identifiable assets of the company that's being acquired. Okay, that is goodwill. It's $400,000 in this specific example. Okay, now it is only capitalized when goodwill is only capitalized when a company purchases another company's entire business. Okay, internally created goodwill is never capitalized. Okay, so just so we're aware, when we're doing these goodwill problems, the only time we're actually capitalizing goodwill is when an entire business is purchased by another business. Okay, so we have an acquiring firm purchasing a target firm. Okay, now we have a 5-step approach to solving goodwill problems. We're going to walk through very quickly, and then we're actually going to do a quick problem. Okay, this topic is not too terrible. It's just kind of understanding conceptually, and then the problems are relatively straightforward. Okay, so 5-step approach to solving goodwill problems, recording goodwill problems. Step 1 is to determine the purchase price, which is usually given. Okay. Step 2, determine the fair value of all identifiable assets and the fair value of all identifiable liabilities. Again, we're using fair values, right? In all of these things, we can see it says fair value, fair value, fair value, right? We're using fair values. We're not using book values for these problems, okay? Step 3, derive the fair value of the net identifiable assets by subtracting the net identifiable liabilities from the identifiable assets. That's this here, right? We have to just take the assets and take the liabilities subtracted from the assets to get the net identifiable assets. Step 4, determine the amount of goodwill by subtracting the fair value of the net assets from the purchase price. Okay? That would be the actual goodwill. Then step 5, the last step, is to capitalize all the asset and liability accounts on the acquiring company's books along with the goodwill. And then when recording the purchase of another company, the acquiring firm debits all the assets acquired and credits all the liabilities acquired at fair market value. Okay? So let's just go ahead and go through a quick problem here. Okay, so let's go ahead and just line these up like this so we can have both showing. That looks pretty good. So on January 1st of 2017, Bob Company acquires Bill Company for a purchase price of $5 million cash. The following information is available concerning Bill Company's net assets and liabilities as of January 1st, 2017. Okay, so again, Bob Company is the acquiring firm, okay? And then Bill Company is going to be the target firm. Okay, they're the ones that are actually getting acquired. So Bill's getting acquired by Bob. So Bob, assuming that we actually end up recording goodwill, the one that's going to record goodwill is Bob because they're the one acquiring Bill. Okay, then it gives us all this information. It gives us book value and fair value Again, we do not care about book values, so we'll just cross those out. As we said at the beginning, we care about fair values, not book values, okay? Additionally, Bob Company identified a customer list that was worth $10,000 and some extra accrued liabilities of $5,000 during the due diligence phase of the purchase of Bill. Okay, prepare the entry to record the purchase of Bill Company by Bob Company. Okay, so we're going to go through our steps. Okay, step 1, determine the purchase price. It's $5 million. It's told to us in the problem. It's just given. Step 2, then we have to determine the fair value of identifiable assets and the fair value of the identifiable liabilities. Okay, all the assets are starting at the $50,000 and they end at the $150 because that's cash through patent. And then we also have this $10,000 customer list. So we just add all those up, 50 plus 90 plus 2.5 plus 1.5 plus 150 plus 10 gives us 4.3 million for the fair value of the assets. The fair value of the liabilities is these two right here, accounts payable, bonds payable. Plus we also have 5,000 of accrued liabilities that we identified. Okay, that gives us 515,000. Then, so that's step 2. Step 3 is to determine the fair value of the net identifiable assets. Okay, that means we just subtract the liabilities from the assets. That gives us 3,785,000. Okay, step 4 is to solve for goodwill. Goodwill is defined as the excess of the purchase price over the net identifiable assets. That means that goodwill in this case is 1,215,000. Okay, so again, once we get to this step, we just take the purchase price, we subtract away the number that we solved for in step 3, which is the fair value of the net identifiable assets, which is the excess over and above the fair value of the net identifiable assets is 1.215 million. That's the goodwill. Okay, then what we want to do is that we just want to prepare the journal entry. Okay, and again, we're using fair values. Okay, so every one of these debits and every one of these credits is at fair value. Okay, so cash debited for 50, accounts receivable debited for 90, equipment debited for 2.5 million, building debited for 1.5, patent for 150,000. The customer list from down here, 10,000. Goodwill we solved for, debited for 1.215 million. Accounts payable credited for 60, bonds payable credited for 450. We have the accrued liabilities for 5 million, and then we paid out cash of 5. Sorry, accrued liabilities of 5,000, then we paid out cash of 5 million. Okay. Again, the other thing is to note is that these equity accounts we ignore. We don't do anything with them at all. The retained earnings and the common stock, we don't do anything with those. Okay, so basically we went through that relatively quickly, but this is a relatively straightforward topic. It's kind of just basically going through the steps that we talked about and determining what the goodwill is. And then once you've done that, you actually just capitalize all the asset and liability accounts at the amounts that are the fair values. Okay, so that's the end of this topic, and I hope that was helpful.